I do not have a video, unfortunately. Sorry about that. But I've got oysters. I don't know if anybody likes them. They're not that fun. I know Jason hates them, but we'll go with that anyway. As I prepared this presentation, which is about our approach to global equity investments, I realized there is a lot of interesting similarities with oysters. So I'll just drop you a few fun facts as we go along. Right, so you've heard now about Jennison, Evenlode, Lyrical. They are single manager, single style fundamental strategies available under Curate and held across many of our multi-asset and multi-manager solutions. You've heard yesterday from Robeco as well, who instead ran multi-factor, multi-style systematic solutions, again, available under Curate, but also widely invested across the board. But if there is one place where everything comes together is our flagship multi-manager, multi-style global equity fund, which we're just going to call Jeff because it's way faster. Jeff is our best-in-class fund in terms of manager selection, is very diversified from a portfolio construction perspective. It's flexible, surprisingly, in its allocation and its in its speed of execution of investment ideas, and is in a very secure fund structure, as we'll see later on. Manager selection is something we take really seriously. Ray showed how many managers are available out there in the world. Is really a long list, and you see on screen 12 different names. These are either managers we own right now in Jeff or managers that will own imminently, let's say. Just waiting for some operational bits. They all serve a purpose within Jeff. They all invest with different styles. They are different people running them. And some of them we've been working with for 15 years almost, since inception of the fund. Others have joined us later on. Others have found their way out of Jeff. So it's a continuously evolving solution. But one for the long term, especially because finding these managers is not an easy job. You need to find the right people with a sound philosophy, with a very strong investment process, which is what eventually drives long-term outperformance. And they're not all sitting in London. They do come through London every now and then, for Think Tank especially. But they're spread all around the world, and scouting for them is really not an easy job. But if you do a good job, actually you get rewarded over the long run. For instance, Artisan, who you would have heard from a think tank last year, they are based in Chicago, and they've been in Jeff since inception, pretty much in 2009, so 15 years ago. They run a global large cap value equity strategy, and over the past 15 years they rank number 3 in a list of something like 70 equivalent managers in the UCITS space. So I guess very strong, about 12% total return per annum. And likewise, Jennison, don't need me to show this. I mean, Mark bragged a lot about performance yesterday, and you know that very well now. But since we appointed them in March 2012, they score number 1 in a list of 250 global growth managers available in the UCITS space. And even one of the latest additions, which is more on right, Fuji Yield, a Japanese equity strategy we bought in December 2021, ranks highly in what is a much smaller universe, unfortunately. There is not many Japanese managers in the UCITS world, but they do rank quite highly, and we're very satisfied. It's not all good stories, to be honest. We've made some bad investments in time. We've fired managers that disappointed us. We've fired managers that were just not as good as perhaps other ones we've found along the way. So it's, again, an evolving product. But I guess that's how it should be. So the first fun fact about oysters is that there is more than 100 species of oysters in the world. But like Ray showed, there is way many more equity managers available. So, be careful in your manager selection. And being a multi-manager means you are also running a very diversified portfolio. Diversified in terms of styles. We own momentum, quality, growth, defensive, and small cap managers. Also means being diversified in investment approach. We own fundamental managers like, your classic stock selector with 30 to 50 stocks portfolio, one style, very niche, but also Robeco with their systematic portfolios. And we think it makes a lot of sense to blend them because it's like having two very different people in one investment team, and, blending, like we always say, blend is your friend, because really it helps out a lot to think differently and approach the same objective, which is that of delivering performance from a different point of view. Obviously, being that diversified means also we end up with a lengthy portfolio of 600 stocks, which is great because diversification, is a free lunch. It decreases risk without decreasing alpha. Obviously, as long as you're not compromising. And, if there is one thing we don't do is compromising on investment selection. We only have 10 managers across a list of thousands. So really, we're just selecting the ones we think are the best. And this allows a lot of flexibility for us. So you see on screen, 15 slots. It's all of the sleeves we have in Jeff right now. There is 4 for Robeco because they run actually 4 single factor sleeves for us in Jeff. And having this many degrees of freedom allows us to express any view we want at any point in time. Say, for instance, we become very bullish on value and we want to overweight the factor without wanting to overweight classic, value countries like, UK, as has been a long time, or perhaps Japan. What we would do is overweight the blue boxes and underweight the yellow boxes. By having many levers to pull allows you to express a very precise view without disrupting any other part of the portfolio. And likewise, we can play aggressive versus defensive stocks, which is something we are doing right now, actually, as we'll see in a second. We can play small versus large caps, also a theme we're liking right now. And we are playing through these managers. You can adjust your exposure between fundamental and systematic managers, which is not something we do tactically, I guess. It's more of a strategic choice. But, there is points in time where, for example, you want to be overweight value without taking any additional stock concentration risk. And how do you do that? Well, increase Robeco value and decrease the other fundamental value managers. You keep the same value exposure or you increase it and you don't affect much of your stock selection. And obviously, we can be thematic about these. We added Moral Right in December 2021. Back then, we thought Japan was a very good market to be in, and we could just add one manager in there, get you that overweight to the region, and and see how that goes. The second fun fact about oysters is that they change their gender multiple times in their life, which apparently is very good for surviving. And, we took inspiration in Jeff and we change our holdings and our investment views anytime there is need. And that's the only way to navigate volatile markets, in my opinion. And finally, I mentioned how secure Jeff is actively managed, is very liquid. 600 stocks is allows you to actually be big and still maintain very good liquidity. All holdings are directly held and sub-advised, managed by specialists on a segregated basis, and all is encapsulated into a daily traded UCITS fund. But I think what's most important and makes it a secure product is that it's been managed by us since inception 15 years ago. Obviously, people change and the momentum team has changed, but the philosophy and process have remained stable. They have evolved as things do in time. But the core engine moves slowly but surely. So why does Jeff make sense now? Put very simply, we see there is a lot of interesting opportunities away from the benchmark. The benchmark has been dominated for years by the FANGs first and then the Magnificent Seven. And even Jennison, you've heard from yesterday, they have been overweight that part of the market for many years, and now they are reducing that exposure. Even, they're left only with 2 of the Mag 7 or 3 maybe, and they've been reducing their weights drastically. They think this cycle is over, and we've been of that opinion for some time now. One area that we like particularly is small caps, or rather I should say we don't like mega caps. So we try and underweight mega and overweight the rest, including small and mid. We think there is a good 30% potential for outperformance if small caps revert to historical average against large caps. Simply put, we think growth shouldn't come just by, in 7 stocks. There is a whole market out there of great companies, and with the right active managers, it's a very good market, even though might be not that, reliant on AI. I mentioned Japan. We've been positive on Japan for 3 years now. Has been a very cheap market for 2 decades. Then we saw something changing. We saw quality of the market improving. We saw, the stock exchange and the government pushing for better shareholder returns in Japanese stocks. And that's the catalyst you're waiting for to unlock value. So we went overweight. Japan has performed well, but we still think there is a good 25% outperformance against MSCI World in Japanese stocks if things continue the way they have been for the past 3 years. And the latest idea is defensive stocks. And I don't mean defense. I don't mean weapons and, military. I mean boring stocks. I mean financials. I mean healthcare. I mean real estate and property and infrastructure. I mean utilities. Those stocks that are not that exciting. They never deliver exciting earnings calls. They never surprise on the upside or the downside. Their returns are very stable. Their cash flows are very resilient in what could be a slowdown in demand and growth over the next couple of years. They behave very much bond-like. They pay dividends. They're unexciting, which has been bad for them over the last couple of years. With rates going up, being a bond-like equity is not good, right? Rates go up, yields take a toll on your share price. But now the rates are being cut, now that AI is not as exciting as it used to be, now that demand might be coming down, now that growth is lacking, with China having all these problems, we think defensive stocks are a very attractive place to be. And only a couple of weeks ago, we increased exposure to the area via one of the Robeco strategies, namely the conservative one. Starting on the 10th of July, we've seen a bit of a rotation in market. We've seen mega caps selling off and then they recovered some, but still sounds like the market narrative has changed. And I very precisely put that on a performance chart. And over those 2.5 months, Jeff is ahead of MSCI World and S&P 500 by 2 or 3%. I don't like showing short-term performance, and I'm not saying this is going to continue forever, but I just want to show that things can change rapidly. And when you're an active manager, you're running active risk against benchmark, and things can be significantly different if markets turn your way. But being an active manager is not always easy. We've gone through some very tough times when the FANGs and the Mag 7 were destroying the market. We were underweight those and we were lagging, especially, the 1 to 5 years has been the toughest time. But since inception returns of Jeff are very strong. We rank first quartile against Global Equity Universe according to Morningstar. And as you can see, now that the rotation has started, we are once again in the first quartile, but the 1 to 5 years periods are a bit harder for us. It's still above average, which I guess is nice, above median. But obviously, we want to be on the top, and we weren't for a few years because of our active positioning going against the trend, I guess. Another fun fact about oysters is that, they can survive up to 2 weeks out of water, which I found incredible. Maybe it's not fun, but it is incredible. We need to survive a lot longer through volatile markets. And especially through times where being active is not a great place to be. Right, enough with Jeff. I want to briefly cover the 2 Robeco strategies because, Mike Chen yesterday discussed a lot about their research and the next-gen research they do. But I think it's worthwhile going through what they do in their 2 strategies that are available under Curate. Robeco run a few different mandates for us. The ones we have in Jeff are slightly different from these, but obviously based on the same engines, on the same research, and the same philosophy underlying that. So what we call SU and GEM, because we love acronyms, SU being the Global Sustainable Equity Fund and GEM being the Global Emerging Market Fund, they're extremely similar. They share everything except for the region and the sustainability that only SU has. But they both are core multi-factor data-driven solution. They sit in a sweet spot between active and passive, I guess, where they try to get the best of both worlds for our clients. They are, like passive, very low cost and very diversified in styles, in countries, in regions, and they give you that core exposure to global equities that you typically buy passive for. But unlike passive, they actually can and do deliver outperformance. How they do that? Well, they get you exposure to rewarded premia like value, momentum, quality, and technicals. You see a bunch of definitions on the screen. But there is a lot more to it. It's a very sophisticated process. And all that Mike discussed yesterday on, studying your voice or, body language in earnings calls or anything like this, employee satisfaction on Glassdoor, all of these factors also enter these funds and also the ones we have in Jeff, obviously in a moderate manner. Robeco are very cautious in the way they think about new factors to add. But everything is what I would call a sophisticated process to deliver performance over the long run. And everything is data-driven and is very broad. These strategies typically have 400 or 500 stocks, and they can achieve a lot by taking many, many small deviations rather than a few big ones. So again, a very different proposition from that of the three fundamental managers you heard from yesterday. And again, that's why I think it makes a lot of sense to blend them in a product like Jeff, where sometimes it's the style that is working, sometimes is actually the stocks within a certain style that are working. And it's nice to have both and have a sort of all-weather proposition. I always have this slide on why Robeco. For the think tank aficionados, Robeco have presented for 5 years in a row. They are our partner on the quant equity side of things. They are excellent, in my opinion, in the research. They employ more than 40 PhDs in the quant equity team. They have a very long heritage of quant equity investments, and they are leaders in sustainability, which is, I think, is a very nice thing. And another fun fact about oysters is that they can live more than 100 years. And Robeco just turned 95. So they are getting in that oyster area. We'll see in 5 years how they behave if they are still presenting a think tank. So in summary, Curate's systematic equity solutions are, somewhere between, again, that sort of sweet spot between passive and active. And for a little additional cost increase, you can get a lot of additional value in terms of access to research, in terms of access to sustainability integration, obviously just for the Sustainable Equity Fund, in terms of outperformance, and in terms of diversification benefits. We launched the two strategies in 2020. Robeco had been running them since 2006, actually, so much longer than our solutions. But we launched them in March 2020 for GEM and May 2020 for SU. Very interesting times, if you remember them, in financial markets. We launched GEM on the 30th of March of 2020, the depth of the COVID pandemic. Treasuries were not very liquid back then, but our EM fund launched anyway. Quite a resilient situation. Anyway, since launch of these strategies, they have delivered decent performance. SU is first quartile against peers, on most periods. Ahead of benchmark as well since inception. I don't have longer track record on this, but we can provide it if you like by looking at the Robeco strategies that underlie these ones. And GEM also has behaved pretty nicely ahead of benchmark since inception and in most times, and first or second quartile in anything longer than in 6 months. So I guess I'll just finish by wrapping it up and saying that our global equity offering has expanded in time. Hasn't expanded in the sense that has proliferated. We've just split up some of the things we do, and giving clients access to single solutions when they make sense, or aggregate solutions like Jeff when you just want to enjoy the full strength of our manager selection and portfolio construction skills. And with that, I'll shut up. I'll leave you with my AI-generated oyster image. I told, I think it was Microsoft, and I told it, please do something that reminds me the world is your oyster. And he came up with something very childish. So I added, please make it like Matrix, the movie. And that's what he came with. So please enjoy that. I hope you liked it. Any questions on anything I've said? No question? I'll take it as a compliment. And I wish you a good day.